Let's get some insights in the news shaping the markets. For that, we welcome in Mark Giambrone. He's with us, head of U.S. equities at Barrow Hanley Global Investors. Thank you for being here. We got in our PPI data coming in a little hotter than expected today, and I think people are now looking at that, looking to the CPI tomorrow, and even the core a little hotter, not necessarily what everybody was hoping for. What do you make of it?
Good morning. I do think that there is some significant underlying pressures for inflation. And because of that, although the Fed is clearly signaling that they want to pause and that they don't want to raise rates for the rest of the year, I think the data is worth watching. Fortunately, rates have risen quite a bit lately, and the market's doing some of the Fed's job for it. And that's really their message. So I think they're okay with where rates are at the moment, and they're starting to flow through the economy and having some impact. But there's lots, whether it's wage pressure, energy. I mean, you can point to multiple things here that are still underlying significant rise in inflation, and the data is just not coming down fast enough. So it's worth watching at this point.
Right, understood. Okay, and we'll get our Fed minutes later in the day today, so we'll be watching for that. In the meantime, now there's more talk once again about hard landing and recession. It seemed it wasn't that long ago we were saying soft landing and things look good. What makes this change happen so rapidly, the way now we're changing our language a little and outlook?
I think that if you just go back a brief period, as you're suggesting, soft landing was the consensus and the market was pricing that in. And it got a little too far ahead of itself in my mind in terms of a rosy scenario like that. Everyone would like a soft landing, and that would be the perfect scenario. But when the market prices in the perfect scenario, we're bound to have a bit of a pullback, which we saw toward the end of the quarter with rates rising and some concerns. And so it seems more likely that there'll be a slowdown. It doesn't mean that could crater the market. It just means that once we're priced for perfection, we're bound to pull back a little bit, and then we have to have these dramatic turnarounds and conversation about how we're going from a soft landing to a hard landing. In reality, we're probably going somewhere in between, and market expectations just got a little ahead of themselves.
Right, understood. And, we were showing some of the headlines. It's just worth mentioning to folks that you had Kashkari and Bostic speaking. Kashkari was talking about the higher rate environment and maybe now that it's possible the Fed could do less. And Bostic even said that, you don't need to raise anymore. It seems a little more in that camp. That being said, can we talk about some of the sectors? I know you don't do stock picks, but for people who are interested in the market, sometimes we have people who say, don't leave cash on the sidelines. You should always have cash working. Tell me where you might see some value, whether it's sectors or I know AI is something that's been an investment theme. Tell me about some ideas that you watch.
Sure. I think that there are plenty of places in the market still to selectively put money to work. And two of the areas we like the most are the industrial area and the energy area. And so those two areas still to us look like there's significant value selectively. And we do believe, and it seems likely, that this AI, the real spend behind AI, not just the hype behind it, but the spend behind it is clearly happening and will continue to happen. And so when you look through there are multiple industrial companies that can benefit from the different areas, whether it's electronics or power or cooling. And when you look around the world and you think about supply and demand on the energy side, clearly, again, unfortunately, this week, we're having another conflict that could have an impact. We think energy prices stay higher for longer, and therefore the names that are out there still look attractive to us.
Yeah, I was talking to a CEO of a shipping company, and of course, they follow oil so closely and was leaning more towards the higher end, that the path of least resistance for oil was to the upside. In the big picture, I mean, when people look at investing abroad, do you consider that too?
Absolutely. I mean, you have to take a look at that. And so there are certain, as you look abroad, there are certain countries clearly that are more commodity centric than others. And they will benefit from a higher for longer type environment like this. Within the U.S., I would say that even the companies within the U.S. that are in the energy sector, they're now focused more on returns, meaning returns on capital, and more focused on returning cash, excess cash to shareholders, rather than drilling or increasing supply at a lower and lower rate of return. So even the way managements are approaching putting that incremental dollar to work and trying to impact supply and demand is in favor of higher for longer, and frankly in favor of the U.S. companies also from a price perspective.
Yeah. Mark, great to see you. Mark Giambrone, thank you so much, of Barrow Hanley Global Investors. Thank you, Mark.